Good morning. Welcome to the B.F. Anderson Technical Report for August 22nd. I'm thinking about changing the name of the report to the Trend Following Report, and I may do that next week. Just because technical analysis is one component of what we do, but trends, markets tend to trend. So trend following is what we do and would be a more accurate description. Anyway, let's get right into the charts. This is the NASDAQ. As you can see, correction, rally back above the moving average, then a pullback. Now what we've got here is a double bottom. We've got a low that was set, a rally, and then a higher low. Now we're rallying again, and we're very close. If we break 8,050 on the NASDAQ, we will get above the lower moving average. Now what we want to see is that lower moving average continue to be trending upward. You can see the double bottom a little bit clearer here on the weekly graph. You can see the correction pulled us down right to the 35-week moving average. We held the 35-week moving average. The 35-week moving average is in a very strong uptrend. So things are looking better here. We may have put a bottom in, and I'll discuss that a little bit more here as we go. Now, the advanced decline line, we're seeing more advancers coming in. We had a 1 day of decliners, which was, I believe, was last Monday. And so basically the advanced decline line, which was looking like it was going into a downtrend, has now stabilized and is now looking like it's going back into an uptrend. So maybe the correction is over. The high-low index, we're seeing improvement there. We're getting more new highs, fewer new lows, quite a bounce. On the new lows, on the New York Stock Exchange, we only had 33 yesterday. As you note, since the beginning of August, we got an elevated number of new lows, which is what we call the leaking boat. So it was just a time to be cautious. However, it does look like the new lows are starting to improve. The long-term indicator, which is the 10-month moving average versus the 20-month moving average, continues to stay in a very positive uptrend. No problem here whatsoever. The last thing we want to see is something like this here. This was the years of 2014, 15, and 16 going into the election. This was not good. This was looking like a bear market, and actually it was a bear market. Now, this is why I think the correction may be over. We get the put-call ratio. This has been a very excellent indicator. Every time we get down here into greed or extreme greed, we tend to set up for a correction. However, then we get up into fear and extreme fear. That usually is where bottoms are putting in. So in other words, you have to think like a contrarian. You can't panic when everybody else is panicking or get greedy when everybody else is getting greedy. Right now, it is a window of opportunity here, and the correction could be over because of that one reason. The S&P 500 index here, I've got the 200-week moving average, very solid uptrend. Low, higher low, higher low, high, higher high, higher high. So that's very positive. Now, the one thorn in my side, and it just continues to be a problem, is the value line geometric index. Now, this index is important because of really one reason. It really measures where the market broadens out. In other words, back here in the 90s, between 1995 and 2000, which was a fantastic bull market, everything was going up. In other words, the market was very broad. It was a broad participation. So without the value line geometric, it's just very frustrating because it's just basically saying that the average stock is just not outperforming. You've got, the S&P 500, you've got the NASDAQ hitting new highs. This did hit a new high, but it hit it back in 2018. Then we had the bear market in 2018. We pulled back, but the only good news here is we are making a higher low at this point. Now, on the global side of things, where we're looking at some international stuff or international stocks, again, just like the value line geometric index, it's just not broadening out. We're not seeing a broad international broad market rally. It's kind of confined to just a few sectors and a few companies. Now, I wanted to go to the yield curve because it's in the media. Now, what I want to basically point out here is this. I have never seen a recession advertised. It just doesn't seem to happen. In fact, there was a movie a couple years ago called The Big Short, and it's a great movie. I would recommend it highly. The story goes where we were going into the financial crisis of 2008, which was the mortgage crisis, and not one economist predicted this big recession that we had. Not one. However, there was a hedge fund manager that figured it out, and that's what the story is all about. But the point I'm making here is that the media right now is really pushing the concept of we're going into recession because the yield curve is inverting. Well, let's go back and just look at how this could really mess you up. Right here in 1995, the yield curve came very close to inverting. Here it is right here. I'm gonna bring the yield curve up here. This is the 2-year bond versus the 10-year bond. Now, this is a reading of 0.10. In order to invert, you have to go to like a negative number or 0 or below. Well, the yield curve got very close to inverting, but then we put in a V bottom, and the yield curve basically stabilized, and no one talked about it anymore. So if you go back and look at what happened back here in 95, the yield curve came very close to inverting. You know, you had a down market, so everyone's going, oh my goodness, we're going into recession. And then look what happened. We turned and went into a fantastic bull market. So it could really mess you up. So be aware of that. Now, this is the yield curve where we stand today. This is as of yesterday. It does look like a V bottom, just like we saw it back in 95. You can see here 95, V bottom. Right here, we've got a V bottom in the yield curve. Now, we got down to 0.01, so, I mean, we're very close to inverting, but we haven't inverted. In fact, yesterday we went to a low of 0.03. So, you know, don't put too much into this. Anytime the media focuses on something, it rarely happens. General Electric. This is just a story I think we need to all understand. What happened to General Electric? Well, you can see here that the stock has just dropped dramatically. And so we have to ask the question, is GE going bankrupt? Now, the chart would tell me that this company is in serious trouble. And I think the lesson to learn from this is if you go back and study their history, anytime a household name or a large company brings in a management team that tries to diversify the company away from its core businesses, be very cautious, be very aware of this. What happened to GE was they decided to get into the long-term care insurance business, and they've just gotten themselves into a pile of trouble. Now, there's an analyst out there named Harry Markopolos. Now, Harry Markopolos is famous for sniffing out the Madoff scheme, the Madoff Ponzi scheme. So he's saying that GE is going to go bankrupt and that this is a bigger accounting fraud than Enron or WorldCom. So this is a very bold claim. But if you look at the chart, you kind of have to ask the question, is Markopolos possibly right? He is possibly right. So the whole problem here is that you get these mature companies that, you know, pay dividends and all that kind of stuff. Now, remember, dividends are an expense to the corporation. It's cash going out. So you kind of have to ask the question, you know, if a stock pays a dividend, is that a safe investment or a riskier investment? Well, the only way I know to look at it is let's say you had $100 in your checking account, and then you had an expense that cost you $50, and you've only got $50 left in your checking account. Are you in better shape, a better situation, or a worse situation? I think the answer is obvious. You're in a worse situation. So what happens is these corporations, they become so focused on just paying the dividend, and then they start getting involved in things that get them in trouble, and then the next thing you know, the company's in real serious trouble. I think GE's in serious trouble. All right, let's go to the top 5. Carvana, interesting story here. You can see here the consolidation period was quite a couple of months here. Stock broke out on earnings. We got what we call a gap up buy signal on very heavy volume. It's got what we call an ascending flag formation. You actually had another gap up the following day, and then we're actually getting another gap up today. This company is selling used cars using vending machines. It's all internet based. It's kind of interesting. This is Enphase Energy, which is a solar energy play, another gap up situation based on a good earnings report, ascending flag. They're involved in solar, microinverters. This is Guardant Health, a name that we're familiar with. The stock did have a gap up, but then went into a descending flag, but does look like it's starting to stabilize and forming a cup bottom and somewhat turning up. But it's one to keep an eye on. This is Roku, which is a stock that we own. Again, we got an earnings report, gap up, gap up, gap up, all-time new high. Pull back, descending flag, but now forming a cup and turning up. Roku is involved in streaming, which is cable cutting. Shopify, this is one of the prettiest charts out there right now. As you can see here, this stock is just in a very, very steady uptrend. Broke out to an all-time new high yesterday on above average volume. This company is basically helping companies develop platforms on the internet where they can do e-commerce. So all in all, what I'm saying is, be aware of what the media is telling you and take it with a grain of salt. A lot of times we just get more misinformation. I can remember back in the 70s and 80s, I was trying to invest in Walmart, but I would read the Wall Street Journal and there'd be an article in there about how overvalued Walmart was. Well, don't forget, $10,000 in Walmart in 1975 by 1990 was worth $12 million. So overvalued, I'm not so sure. If you have any questions, give me a call. Thank you.